that time of year again, and OGs will know this. People who are new to the channel, if this is something you've only found recently or since last summer, for the summer I go back to New York from Texas, and I'm currently on the drive. So I'm burning that gas, I am consuming that oil, and we will get to oil towards the end of this video. But first I want to talk about broader market observations, and particularly the Fed, because the Fed has been saying things they haven't been saying this entire time. For the past few weeks, they have been vague, and the market has chosen to take that vagueness, at least initially, in a dovish direction, saying, they're not being committal to an additional hike. We think they're done. And they were choosing to lean on the more dovish side of things. However, the more recent Fed speak is taking that notion of vagueness, and instead of applying it to, not wanting to commit to an additional hike or, being content with where we're at, in my opinion, the pieces that we're getting now that are still not necessarily committal are being vague, but vague to the upside. Now, why would they be vague to the upside? They would be vague to the upside because the Fed has done all this tightening. And let's not forget, the peak in yields came over 6 months ago. I believe it was October. So here we are about to be in June. And for the last several months, core inflation has been flat against tougher comps, arguably reaccelerating month on month. And the Dallas Fed trimmed mean inflation rate. Let's not forget, the Fed loves its trimmed mean inflations. It prefers core to headline, et cetera, et cetera, et cetera. I believe that is at an inflation cycle high. So this is extremely concerning to the Fed because, yes, they want the economy to be strong, but they view inflation being strong as worse. Why do they view inflation being strong as worse? Because it impacts the elderly, it impacts lower income people most. Prices go up, even if wages go up, it still impacts individuals who need to purchase goods, because the trend has been, for the most part, that wages haven't been keeping up with inflation. So it hasn't been good for America overall. And inflation is staying, at least in the core sectors, relatively strong despite the big drop in energy prices, despite the drop in commodities more broadly from the shock levels that we saw last year. So what exactly am I seeing from the Fed? We heard earlier Kashkari float the idea of 6%, say he just didn't know. Barkin today saying he doesn't know how much hiking we need. We're in restrictive territory, but we don't know how much farther we need to go. Now, here's the thing. He also said that inflation is not going to come down as quickly as people like. And that certainly seems to be the case. I mean, the market has been trying to forecast, trying to discuss, trying to project a rather rapid decline in inflation. And at least in everything except headline CPI, that hasn't been so much the case. So I think the Fed is going to remain hawkish. And this isn't just, something they choose to do. I know it looks like stocks are just, continuing to go through it. This is the most important aspect of the economy, of the stock market, and of asset prices. And we're seeing it in some areas. We're definitely starting to see it in real estate. That's going to pick up and get worse. Stocks have just continued to go, but it's only some stocks. It's only the, S&P 7, so to speak. The broader market is remaining weak. Even today, the RSP looking weak, still very much in a downtrend. The Dow still very much in a downtrend. So if you're willing to look and, and focus under the hood a little bit, you can see the market is starting to show signs of weakness. And the Fed is remaining hawkish. And interest rates are the single most important factor for determining asset prices. And the Treasury is going to suck liquidity off the sidelines. And S&P just said that we're entering an EBITDA. I know it's not a good, number. Charlie Munger doesn't like it. Warren Buffett doesn't like it. I don't like it. But they say they say they have chosen the term EBITDA recession. And I think that's very much the case. Yes, there's a few companies that are still growing earnings at a slower rate than they were in the past. And yes, Nvidia is growing at a faster rate. But I think for the market overall, and I think for those other companies as well with time, because they are business to business, Nvidia, Microsoft. So if all the rest of the businesses start to slow, they will slow. That this will trickle throughout the broader market. And I'm talking about even the S&P 7. These companies, they have experienced big declines. Apple, Microsoft, they've experienced 50% declines, and they are trading near all-time high valuations. I get it. Microsoft might have been 60 times earnings or whatever during the dot-com bubble, but it's definitely up there in terms of its peak multiples. I think the multiple right now is even higher, or at least close to its peak 2021 multiple. So very interesting picture we're experiencing right now. And we saw very interesting weakness today. We saw the market up tremendously pre-market on debt ceiling stuff. That pulls back. Now, here's another thing I want to talk about with the Fed. Barkin said, and this is like, pencil this into your understanding of the future forever. We were just in an environment where interest rates were 0%. The Fed didn't start hiking until March of 2022. So we were in multiple months, even last year, of non-zero interest, or of zero interest rates, at least in terms of the federal funds rate. I get it. Rates start to anticipate that. But he said he doesn't really see us going back to zero in any future recession. That is like a whole new paradigm thing, because we're now starting to approach prices we were at last year, or in 2021, at the peak of a tech boom with 0% interest rates. Not a recession with 0% interest rates. A peak tech boom. And I mean peak, because this is not going to happen again. A massive work from home, tech boom. Like, this was literally all out maximum that you could experience positive with tech. So bottom line, in my opinion, is the sand is changed. The soil is changed. It's a different climate. We went from summer and the best soil we could have. We're now going into winter. And I know the stock market right now it doesn't look that way. But the economy is beginning to do that. And you're seeing it in the more cyclical stocks. You're seeing it in retail. There are definitely signs of that out there. And it's only just starting, The Fed is still hiking. They're still going to hike. And we're only beginning to start to see the effects of past hikes. So if I were long right now, I would definitely be taking advantage of these prices and locking in some gains. And either being defensive and in cash or shorting this market at this level. That's what I believe. Now, I want to talk about energy, because energy is obviously a very volatile sector. But I don't think people are interpreting the headlines correctly, particularly what's coming today. People are hearing and seeing record, Russian exports to China. And I get it, China might go through a COVID situation. We'll keep our eyes on that. I don't think it's going to be too crazy, because they can't really afford to lock down again based on the social unrest they had last time. But for another day, we'll see how that develops. Russian exports increasing to China. China is the main recipient of Russian oil right now. It's one of the only ones who are actually taking it. Russia is also exporting it to Saudi Arabia, who's then exporting it to Europe. But Chinese oil demand is beginning to show significant signs of recovery. I believe 1 million barrels per day in a single month in April from where it was previously. So, in April over March. So this is not slouching oil demand anymore. And one might question, well, why aren't we seeing that in prices? Remember when the Saudi Arabian guy recently said shorts are going to be ouching? Now, he could say that and be wrong, of course, but that would significantly risk his credibility. There's an OPEC meeting coming up. I think there's a decent chance he's going to be right. Why do I think there's a decent chance he's going to be right? Because short interest in oil, that means the amount of contracts that are currently short, I believe is at the highest in 10 years. This is higher than it was before COVID. This was higher than it was during the COVID decline. This is higher than it was when prices were negative $37 a barrel. This was higher than during Omicron. This was higher than during any of these periods. Higher than during 2008. Higher than during any other recession scare before. So we have tremendous oil shorts. And this is not an environment where producers were overproducing previously. If anything, they've been underproducing. That's why we saw a massive increase in prices. And we were only able to tamp down those prices through an SPR release, which is about to end. So if OPEC cuts, or if the demand picture continues to stay strong, I expect these shorts to be squeezed, this record shorts to be squeezed. I don't know if they're going to do something at this OPEC meeting. I think prices coming below 70 today gives them plenty of ammunition to do that. The first time prices went below 70 after SVB, that's exactly what they did. They cut supply. So I would wait before getting nervous about oil until all that happens. That's what I would do. I've shared with you in the analysis. You make your own decision, but that's what I would do. So that's today's video. We'll be back in the car tomorrow and for the next few days, crossing country. So until then, peace out.